term which you often use, which is less well known to some investors, is free cash flow yield.
Yep.
What is a free cash flow yield and how do you measure it? As in, when is it too low and when is it attractive?
Yeah, okay. Free cash flow, what is it, first of all? Okay, free cash flow is the cash that a company generates and what it's got left over after paying for everything. It could do whatever it wants with that. It could pay it all out to investors. It could invest it in the business. The late Sir Peter Burt from Bank of Scotland, I once said, look, I think we'll put it in a room and look at it.
Or they could buy their own shares back, couldn't they?
Yeah, you could buy your own shares back. So it belongs to the shareholders and the company can dispose of it in any combination of those ways that they want. We try to value companies by taking that free cash flow and dividing it by the market value of the company to get a yield that we can then compare with the yield on bonds, bank accounts, et cetera, And what we're looking for in a company is one where a combination of that free cash flow yield, so if the free cash flow yield divided by the market value comes out at 3 or 4%, we go, okay, that's fine. We then compare it with a couple of other things to see where we're going. One of them we compare them with is government bonds. What's the yield on government bonds? Because after all, government bonds are a safe investment.
Apparently.
Well, allegedly. If we can buy very high quality companies on a free cash flow yield that is the same as or more than the yield on government bonds, we'll probably be all right in the long term. And the reason I say that is pretty simple. The coupon on the government bond doesn't grow over time. Whereas our free cash flow from our companies will grow over time unless we've got something seriously wrong. And so that's kind of the bottom line. Is the free cash flow yield the same as or more than the government bond? Because if it is, providing we can take the time to sit here and wait, we're probably going to be okay. That's quite an important qualification. The other thing we do is, in terms of trying to work out what our total return might be, is we have a guess at the growth rate in that free cash flow over time. What will it grow at over time? And my team are quite good at trying to sort of guesstimate that over about a 4 or 5 year time horizon. Why 4 or 5 years? Just it's a period we found by experiment that they're quite good over getting it at. Partly because they're very good at it. They are. Partly because these are quite predictable businesses. And so we take that growth rate over the next 4 or 5 years and we add it to the free cash flow yield. One of the rule of thumbs in investment is if you take the yield on something and you add the growth rate, you get the estimated return if nothing else changes, which of course is rubbish because something always changes, but it doesn't matter. So if you take the earnings yield on a company, which is the inverse of its PE, and you add the growth rate, you should get to the return. So if we've got 3 or 4% free cash flow yield and we think we're growing at about 8%, then I think my expected return on that portfolio is about 12% per annum. Just add the two together. It's a rule of thumb.
So over a 10-year period for a patient investor, that's a very handsome return, isn't it?
Sure is. I mean, over the very long term, 50 years, the S&P 500 has compounded at about 9%. So if we can beat that by 2 or 3%, that's pretty good, I think. Now, we hope to do better than that, but the means of doing better than that are one of several things. One of them is, from time to time, I don't know why, the market goes completely mad and offers us an opportunity to buy something very cheaply. We bought Microsoft on a 12% free cash flow yield. That shouldn't exist. It's so bizarrely cheap that Julian and I had to sort of lie down in a dark room with a towel on our head and think, what have we missed? And the answer was nothing at all. But it doesn't. Occasionally those come along and they give you that opportunity. Or another example for you, IDEX that we own, which is the veterinary diagnostic equipment company, ran into two things at once. One is it changed from wholesale distributors to going direct to vets, which disrupted its sales, its cash flows. And the Sequoia Fund, which is its biggest shareholder, had a meltdown because of its investment in Valiant Pharmaceutical and had big redemptions, had to sell its holding. So we got this opportunity to buy it very cheaply. It went up at 100% per annum for the next few years. But you don't get very many of those. Markets are not that inefficient. So I would say that sort of 12% number that I've just named you is very good compared to the long run, but we hope that opportunity will rise and we'll grasp it to better that.
So 12% compounded over 10 years. That's almost doubling your money over 6 years.
It is, yeah. People get this wrong because 6 years will double your money at 12%. 6 12s are 72.
Yeah.
It doubles your money over 6 years.
The rule of 72.
The rule of 72, yes. It's an arithmetic rule for working out compound interest, basically. One of the simplest questions is, if you make 10% per annum, how long does it take to double your money? And of course, with simple interest, where the interest isn't added to the principal each year and it earns interest, with simple interest, the answer is 10% per annum, 10 years. But of course, with compound interest, it's not, because at the end of year one, you'll have 110, and 10% on 110 gets you to 121, right? And so on and so forth. A quick way to do it is to divide the rate of interest that you're going to achieve into the number 72, and that will tell you how long it takes to double your money. So if it is 10% per annum, you will double your money in just over 7 years. If it's 6% per annum, since 6 goes into 72 12 times, 6% per annum, 12% per annum, divide into 72, you will double your money in 6 years, basically.
So actually the opposite of that is that if inflation was at 7.2%, you'd halve your money over 10 years.
Yes, you would. Yes.
Oh, that's terrifying. That might well be the future.
It could be, yes. Yeah.